Some things don't add up. The current narrative doesn't make sense. If everybody in the space is always so bullish about their favorite altcoin or about Bitcoin, everybody thinks that the price will just go higher, that everything goes to the moon. Why do we even see those drops of 30, 40, 50, 60% sometimes? If everybody is bullish, shouldn't we see much less volatility? Shouldn't we trend up much more consistently? The answer, of course, is that people tend to take profit. And they tend to take profit when there's too much weighting of a particular asset within the portfolio. Now, the nice thing about Bitcoin is that it's a public blockchain. We can see who's taking profit, how much profit is being taken, and at what point might the market be heated. Profit taking can also be called realizing market cap. And what we see over here in black, that's the Bitcoin price. What we see over here in green, that's how much market cap gets realized at a particular point in time. And this was very high when Bitcoin hit around 72K. It then rose again when Bitcoin hit around 100K. And now that we are close to new all-time highs, we still see some profit taking, but it's not yet at the levels that we have seen before. Now, with those peaks, we subsequently saw Bitcoin drop 20 to 25%. I don't think that we will drop 20 to 25% right now. The profit taking is still too slow. Yes, there has been a single event, and that made it to the news where there was a lot of profit taking. There was dormant Bitcoin, 80,000 Bitcoin, that just moved hands on one single day. It was Bitcoin that was mined during the Satoshi era times, and it picked up the realized profit very, very quickly. But again, if we just smoothen this out a little bit, it's not that big of a deal in the grand scheme of things. It was big on the single day. It's not big in the grand scheme. Some people that are a bit impatient, that buy high and sell low because they don't hold Bitcoin for long enough, they have to realize losses. And that's what we see in this chart, the realized profit to loss ratio. And of course, it's always better to buy whenever people on aggregate realize losses. And currently we are nowhere near that because Bitcoin is close to all-time highs. But just because people are currently realizing profit doesn't mean we can't go higher. If you're dollar cost averaging in and you've got a long-term time horizon, then of course it sometimes might make sense to wait until we are in the red area. But if you don't yet have sufficient allocation towards crypto, it's not necessarily that great to always wait for the next opportunity, right? Just have a look at this. When Bitcoin moved from roughly 10K all the way up to 60K, there was not a single point in time where people in aggregate realized losses. If you then just waited for the next opportunity to buy, you would have gotten your first opportunity at 30K. So if the bull market is strong enough, it makes sense to still buy even into profit realization. And so there is this balance to be made, right? There is unrealized profit and there is realized profit. And the higher the price is going and the less profit gets realized, the more the unrealized profit accumulates. And that unrealized profit might get realized in the future. And that realization, of course, leads to falling prices. And so what we've got over here is the unrealized profit, but also the unrealized loss over time. And sometimes we have both happening at the same time, as in the Bitcoin price is going down. Some people are still in profit because they bought Bitcoin early enough, but the majority is in losses because they just recently bought and Bitcoin dipped enough for the pendulum to completely swing. So the sum of both unrealized profit plus loss, that's the blue line over here. And of course the areas, that's the segregation of profit and loss. We are now at all-time highs of unrealized profit in dollar terms. But again, I don't necessarily think that's too bad because the market as a whole has also expanded massively. Over time, Bitcoin gets used less and less for speculation, and it gets used mainly just for allocating towards the asset class to just ride the expansion of crypto in general. What we see over here is the Bitcoin hodl waves. How much of all of Bitcoin is in the wallets that have moved their Bitcoin within the last 6 months. So that's pretty much the medium to short-term Bitcoin. And this used to be much higher in the past at around 50%. Now it's only at around 20%. And this tends to go up when there is a bull run. As in, traditional media talks about Bitcoin, crypto YouTube channels get a lot of views. Everybody is excited about the rising prices, and so new people enter the space and the long-term holders tend to sell. So it's always a dump from long-term holders that realize profit to short-term holders that panic when the price doesn't rally that quickly anymore. And then, because more Bitcoin is in the weak hands, so this could also be an indicator showing how many Bitcoin is in the weak hands, the more there is, the weaker the potential future price action, right? Weak hands tend to sell earlier when there's a bit of volatility. Currently, not a lot of Bitcoin is in the weak hands. Or to say it differently, most Bitcoin is still in the long-term holders' hands. So even though the Bitcoin price is very high, it doesn't necessarily mean that the market is particularly heated. Yes, most supply is currently in profit, but that's not necessarily a bad thing. Some long-term holders are selling, but it's not yet at the same rate compared to when Bitcoin was at 72K or when Bitcoin was at 100K. People are taking profit, and there is a slight decline in the long-term holder share of network wealth, but it's nowhere near to what we have seen in the past. In other words, I think it just makes sense to continue holding until we really see long-term holders selling. There is a bit of risk, right? Because there wasn't a lot of trading volume in this gap between 104 to maybe 116K. But I use a different approach to time the medium term. And that is the 120-day simple moving average. I talked about this several times on this channel. I actually started this channel discussing this timing approach, and I still use it today. The idea is that we want to be in the market whenever the price is above the moving average, so we ride the current momentum, and we want to be out of the market whenever the price is below the moving average. The moving average being here the line in turquoise and the price being the line in green. Currently we are above that moving average, so we should rather be betting on rising prices. The moving average is currently at 102K. I've backtested all moving averages from the 2-day all the way to the 200-day using this fixed strategy. And I also included some trading fees in this, 0.2% with every transaction. And we go long when the price is above the moving average. We also go short when the price is below. So I've got all of that data that I used for the backtesting. And that's the result that I got. If we use a moving average that's above 30 days in length for Bitcoin, we tend to outperform buying and holding. Buying and holding is this line in black. So on the x-axis, we've got the duration of the moving average. On the y-axis, we've got the annualized performance. The 120-day simple moving average is the one that worked the best. In general, this approach tends to work pretty well. So using any moving average that's say below 200 and that's above 30 is still better than just buying and holding. How much better? Let's have a look at the 120-day SMA over time. So if you just bought and held Bitcoin throughout the testing period, you would have gotten the performance of this white line. And because we use the active long short strategy, we get this performance here, this line in turquoise. That's on a linear scale. Here's the same thing on a logarithmic scale. So this is very nice, constant outperformance. And I use this indicator until today. I think it makes sense to be bullish on Bitcoin whenever we are above the 120-day SMA. And I think those approaches are more useful compared to just volume trading gaps, because those are harder to backtest. The overall macro environment is obviously still bullish because the stablecoin market cap continues to increase. It increases since October of 2023, so money is flowing into the market. People are converting their fiat currency into stablecoins to then buy crypto. This is a very constant trend, which obviously correlates with crypto prices quite nicely as well. When money is flowing in, prices tend to go up. When money is flowing out, prices tend to go down. This crashed, by the way. This started crashing when Terra Luna imploded, when the UST stablecoin depegged and people lost money with the Anchor protocol. But currently, it's not DeFi anymore that's moving the prices. It's Wall Street, right? The Bitcoin ETFs have accumulated 3.5% in the last month if we annualize that acquisition. And on top of that, we've also got the Bitcoin treasury companies. In the last 1.5 years, this went up very, very nicely. Despite the price of Bitcoin going up quite a bit, right, a 4x roughly, the rate of accumulation and the number of Bitcoin has not slowed down. It tends to rather accelerate. It looks like Wall Street's demand for Bitcoin grows faster than the Bitcoin prices. And for Ethereum, the situation is even more crazy. In the last 14 days, if we annualize those, we have 22% supply absorption. And so it's not really a surprise that Ethereum dominance is going up. I do believe it will likely continue to go up at least until we hit 14% in the Ethereum dominance, potentially even 20 to 21%. Currently, Wall Street is mainly buying Ethereum. It's also buying Bitcoin, and the stablecoin market cap is going up. So overall, crypto should be fine. A few long-term holders realizing some profit won't kill this bull market, and especially if you don't mind that Bitcoin sometimes goes down 20-25%. If you don't try to time those kind of corrections, then there's really nothing to worry about, in my opinion, right? I don't have a crystal ball either. It's simply how I see the data. It's hard for an asset to drop in price in the long term if the heavyweights with very deep pockets buy at those massive rates. Now here's the problem with the crypto space. Everybody talks about the next 10 or 100x returns with the next small meme coin, but the issue is if you bought any of those assets that are recommended in those videos, you very likely lost money. And that's simply because returns are concentrated in just a few winners. The vast majority of altcoins loses all the time. And this is all just preying on your emotions, preying on your greed. I'm trying to go a different route with this channel. I'm trying to figure out what are strategies that long-term make money, where we don't just pick the needle in the haystack, but where actually statistics are in our favor. You might have seen my analysis on moving averages, right? How the best simple moving average for Bitcoin is the 120-day. So we should buy Bitcoin whenever the price is above the 120-day SMA, and we should potentially sell it when it's below. So that's this line over here, the line in turquoise. I've been talking about this regularly on this channel, and it helped me very well to time the market, to be out when there's potentially a correction, and to be heavily invested whenever we are in a bull run. And so we get those back-tested results, but that's a problem, right? It's a back test. It's a simulation of how well did this thing work in the past, but there's not necessarily a guarantee that it works in the future as well. And then there are those other counterintuitive approaches, right? Where we don't try to buy the one altcoin that outperforms, but we rather bet on altcoins doing worse because of all of the expanding supply. I talk about this all the time on this channel as well. So for example here, right, this is Balancer, which had a very extensive supply expansion, and that then leads to Balancer going down over time. And then we also talk about how can we potentially reduce the risk that we don't get stopped out during those temporary rallies of 100%. And then we talk about potential relative valuation trades, right? Balancer relative to Ethereum, for example, underperforms more consistently, so we can bet on that going down long term. I made money with this regularly. And so this is then where it gets from simulation to actual performance. I personally have made money with relative valuation bets for a long time now. Almost 4 years, it's 46 months. And had I just dollar cost averaged into Bitcoin, I would have gotten this light gray line here as return. But because I also bet on very poorly performing altcoins to do worse than Bitcoin, I got the performance here in black. And so we don't just have a simulation, we also have actual returns. But again, that's just me, and that's not showing it live. And so I went one step further. I opened up a portfolio of 2.5 months of relative valuation bets, where I showed the members of this channel, what do I bet on? Where do I go long? Where do I go short? And over 2.5 months, that portfolio made 50%. So I started with roughly 40K and then ended up with roughly 60K. But then again, it's just myself again sharing my performance, sharing my trading. It doesn't necessarily mean that you can achieve the same as well. I'm trying to be much more transparent than all of those other YouTubers. I try to share strategies that genuinely work. I'm not pumping and dumping based on any money that I got from any crypto project. I never take any money from any crypto project, but still, this is just myself trading. And so this is then 3 weeks ago where I went one step further, where I changed something, where I said, okay, I'm ready to take money into a capital pool. I execute the trades, and then you get the exact same performance that I get. All the negatives, all the positives. And over the time, we are already in profit. We are now at 4.7% in profit. I started out with my own money with 100K, and various members also deposited quite a bit of capital. And so I was wondering, how can I provide most value? For the people that have a lot of time, but not yet that much capital, they should be able to learn those strategies, those relative valuation bets relatively quickly. They should be able to make money very fast. And that's what all those tutorial videos are for, right? There's a lot of tutorial videos in Premium. Feel free to just binge watch all of this. There are two main videos that are absolutely essential. So that's using perpetual futures on Hyperliquid to bet on relative valuations. And it's this one over here, risk management with relative valuation bets. Because if you don't manage your risk, then using perpetual futures is a bad idea. So when you've got some time, but you don't have that much capital yet, then the monthly membership for 125 is for you. That's just for you to learn all the different steps. I share my own trades as well. You can copy trade me. I will also share my favorite trade with you. So in case that favorite trade will not make money in the next month, then I will also refund you the $125 per month. So it's basically risk-free for you to enter this membership. But in case you don't have time to do the copy trading, in case you don't want to watch the tutorial, then you should probably go with yearly, because over here you get access to the automated copy trading, where we are so far in profit with 4.7%. And while I cannot guarantee that this will continue to stay a profitable strategy, I feel quite confident executing this for the members. Again, because I have very positive experience with that for the last 4 years. And it's not just because of random bets, because I got lucky with a small meme coin that 100x'd. It's because we use the market structure to our advantage, right? When the early investors and the team cash out, when they dump the price because the supply is expanding, then we make money at the same time. We basically flip a chart like this, so that it looks like this. This is the kind of performance we are looking for. And so for the annual members, there is the copy trading mechanism. You just have to watch a single video, 18 minutes in length. It shows how to send the money to that pool. The average deposit is around $13,000. So if you only have a few $100, then the annual membership is probably not for you if you just do this for the copy trading. But if you've got 5,000, 10,000, potentially more to deploy into a risk-on strategy, then feel free to check it out. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers!